what I like to do if I was under pressure in the exam, as I'm sure you'll be, is to tick off these journal entries as you go along. For example, because we've debited bank and credited capital, I've done 2 ticks on my journal entries list. The purchases and trade payables, again, I've ticked it off, 1 each. I'm now looking at the 3rd journal entry, debit cash and credit sales revenue. Debit cash and credit sales revenue. So what do you think we should do? The cash account is the same as the bank account, so let's go back to the bank account, which is where the cash is shown. So I better be careful and say bank includes the cash. So I'll say bank or cash account, both of them. So be careful. So what we'll be saying, debit the bank credit capital for the first transaction. Looking at this particular one, we're going to say debit cash, which is the same as bank, and credit sales revenue. So as you'd imagine, the figure of 6,000 turns up on the debit side of the bank or cash, and we shall refer to sales revenue as 6,000 there. And of course that's on the 2nd of April. As you'd imagine, the other half of that entry is to move beyond the 4th account and open up indeed a 5th. So let's say account number 5 is the sales revenue account. Debit credit, the usual story. And as you'd imagine, that ought to go on to the credit side of the sales revenue account, April the 2nd, cash or bank, 6,000. Okay, so that takes care of the 3rd journal entry. Let's go for the 4th. Debit trade payables, credit bank. Wrong account. Got to go back. Debit trade payables, 5,000. So let's put that 5,000 into place over here. April the 5th, bank or cash, 5,000. And clearly, if you debit trade payables, you need to credit something. That something, as you'd imagine, is indeed this bank account. So let's go back to that bank account now. Which side was that? Check out the journal entry. Is it on the credit side of bank, is it? So let's put that in there. April the 5th, trade payables, 5,000. And so you can tick that off as a completed journal entry. It may be a good idea just for 1 second to check the number of entries you've made. For example, we've made 4 journal entries, or we've reported 4 journal entries in the form of a ledger account. So we've got 1, 2, 3, 4. 4 times 2 is 8. Have we got 8 entries in our various accounts? Let us do a quick check. 3, 4, 5, 6, 7. Is there an 8? Yes, there is an 8th. So we've got 8 transactions for 8 entries for our 4 transactions. Let's press on. The 5th transaction is something about rent. Debit, rent, credit, bank. The rent account hasn't yet been opened up. Let's therefore set one aside, calling it rent account. $450, a debit to rent, and the bank account is cross-referred to. Immediately we go back to our bank account and put it onto the credit side of bank, 450. So back we go. So was that a debit to rent? So the debit is looked after. We're now looking at the credit. The credit, of course, goes to bank. So let's cross-refer as always. For some reason, the question has a slightly surprising date there. Never mind, 450. So that's the end of journal entry 5. We now turn to journal entry number 6, debit trade receivables and credit sales revenue. So let's turn to trade receivables. Rent, let's nominate number 6. We haven't got a trade receivable, so let's make that our 7th. Debit, credit, trade receivables account, 6,000 on the debit side, credit sales revenue, which I believe we've opened up already. Let's go back and check that. Yes, indeed, account number 5. $6,000 appears on the credit side of the sales revenue account, as you'd imagine. So here we are, 6,000 goes in there, and we can say April the 7th, trade receivables. It's actually very, very easy indeed, but it does take a few minutes to do. Journal entry number 7 on the 10th of April is our next concern. Debit purchases, it says, credit trade payables. So back we go to search out the purchases account. Here we are. Account number 3. Onto the debit side we go, referring, of course, to trade payables. $7,000. In the exam, to save time, just do a little ditto, because you know what it is. The computer just wants the final answer on that account. So use dittos, use abbreviations liberally. At F3 level, I mean. So that's the purchases being debited. The next thing is to credit trade payables. Here is the trade payables account. Let's put that 7,000 onto the credit side. And let's refer to purchases. 10th of April, purchases. Or just a ditto if you prefer. So that's the end of the 7th journal entry. Now come to the 8th. Delivery van, which sounds like a brand new account. So let's move off. Here we are, delivery van account. Debit, credit. Account number 8, I suppose. The asset goes up, so you debit it. And obviously, cash goes down. And so we cross-refer to cash as always, cash or bank. Better write that a bit more neatly, sorry. 7,000. So let's go back to the cash account and put that onto the credit side. Shall we do that? Here we are. This is the bank account. I hope you put that 7,000 onto the credit side, because that's where it belongs. Delivery van, 7,000. So, a quick check. How many items have we got? Just make sure you've got 16 movements recorded. Can we check? 5 in the first account. I'll make that 16. Now, the last step we need to take to close off these accounts flows in this sort of style. Let me take you back to the bank account, the first one. Now, this is characteristic of all ledger accounting, so it's extremely important that you pick this up, though we will do it quite a few times over the next few minutes. Check out the debit side and the credit side and see which one is heavier. The best thing to do is to actually add it up, either using a calculator or do it mentally. I'd actually recommend doing it mentally unless it's a very close run thing, in which case you refer to your calculator. Now I can see clearly, as you can, that the bank account debit side is 56,000, quite large, and on the credit side is nowhere near. So I'm confident that it will be a debit balance. That is to say, the debit side is heavier than the credit side. So let's do that. Let's leave a bit of space, almost as much space as you can afford, within reason. So what I'll do is leave 4 or 5 lines, come down to the more or less that sort of area. Put the heavier side in and put that onto the lighter side. Then add up the lighter side, which stands at 12,450. It's almost like a subtotal. Indeed, that is what it is. I'm now going to compare that 12,450. Just write that a little bit more neatly. Apologize. You compare that 12,000 to the 56,000, you find yourself with 43,550. That is what is known as a balance to carry down. And that balance, indeed, is brought down the next day. So we say balance brought down 43,550. Now let me go through that process once more. It's so fundamental, it's absolutely fine to spend a few more minutes doing it. I looked at my bank account. Don't forget, this is the business's version of the bank account. So if you have money in the bank, it's actually a debit, it's an asset. Don't forget that. If you add your 50 and your 6, you have 56,000. You put that 56,000 onto the lighter side, having established that the lighter side only stands at 12,450 at this stage. And the difference between the 12,450 and the 56,000 is obviously the 43,550. Okay, and that's brought down. Now, quite an interesting one here. I wonder whether you are concerned about that. I used the expression earlier that because the debit side of the bank account had more value than the credit side, it's going to be a debit balance. Do notice, however, that when you ruled off this account with that in place, the figure that turns up here, 43,550, even though it appears to be on the credit side, it is actually a debit balance. And that is revealed when you take it downstairs to the start of the new year or the new period. Here we have every 2 weeks a new section done. So actually, when it's brought down, it reveals its true status, be it debit or credit. So in this case, obviously, it's a debit balance because obviously you had more debits than credits in the first 2-week period of this company. Right, let's go to our capital account as we try out a little bit more. Clearly, if I may rule this off, we find ourselves with, having left a couple of lines maybe, the 50,000 is the heavier side, so I'll put that onto the heavier side, bring it onto the lighter side, and the difference between that and the other side obviously is the balance carried down and happens to be 50,000. Again, I'll ask the question, is that a debit balance or a credit balance? At first glance, it looks like a debit balance because it's on the debit side, but actually it's a credit balance on the grounds that the credit side is heavier. So I'll bring that down in this fashion to reveal its true status. So starting up the new 2-week period, we have balance brought down, BAL for speed, saved a few seconds. So there you are. That's your 50,000. We turn our attentions next to the sales revenue account. I believe that's the next account. Actually, it is purchases. I apologize. Purchases, we haven't quite done that yet. So let's get a grip of our purchases account. Again, I'm going to leave a couple of lines, 2 lines, before I rule it off. In real life, a computer would do all this for you. But in the exam, you have to demonstrate some fairly basic skills so that you can actually control what the computer does. Right, you have 12,000. 12,000. And the difference, balance carried down, is 12,000, or forward, balance carried forward, some people call it. Balance brought down, a little bit quicker than forward, brought down 12,000. As ever, this is actually a debit balance because it's on the debit side. And so let's press on. The trade payables is on the credit side a little bit heavy. Again, I leave myself a couple of lines, rule it off, and see what we make of that. So the credit side is 12,000. 12,000. And the difference between the two sides is 7,000, which I shall describe as a balance carried down. Of course, you have the balance brought down of 7,000. And so the process continues. So that comes down like that. Sales revenue, the next account. I thought we had reached this earlier, but now we do. Leave a couple of lines. The credit side looks a bit heavier. In fact, that's the only side that's got any activity. So how do we cope with this? We put the 12,000 in here, put the heavier side onto the lighter side, and the difference between the existing lighter side figures and that big 12,000 happens to be 12,000 anyway, and that becomes the balance carried down, which of course becomes the balance brought down. Of of course, that figure is 12,000. So always leave a little bit of space below the account so that you can see the account, the balance being brought down. Sales revenue is income, so you expect it to be a credit balance. And so we move to rent. Rent, of course, is expense. You expect that to be a debit balance. 450. So I add it up. If you want to go through the proper process. The 450, and the difference between the two sides, of course, is our old friend balance carried down, and of course balance brought down starting off the next 2-week period. So that comes down like that. Then comes our trade receivables. Nearly finished, just a couple more steps. Trade receivables, right. The debit side is heavier. What I might ask you to do is to complete the ruling off yourself, just as a tiny challenge. I wonder if I can ask you to do that now. What I'll do after that is add up all these ledger account balances where you brought them down below the line, and we'll extract a trial balance, seeing whether the whole thing adds up. So how did you get on? Did you balance the trade receivables account and then the delivery van account? I hope you did. Here's confirmation that you did. Trade receivables, the heavier side is the debit side. Why is that? Oh yes, receivables is George, the businessman, expecting that money from his customers. That expectation of an economic resource, that is to say cash in the future, is what gives rise to this asset concept. It's receivable, it's an asset. So let's leave a couple of lines, as always. Before we rule it off, obviously under exam conditions, looking at a computer, the computer doesn't see the neatness of your presentation. You just do freehand lines, okay, without bothering with the ruler. Though in real life one would tend to be a little bit more careful. 6,000, 6,000. The difference, of course, is 6,000. And that is a balance carried down, which, of course, becomes the balance brought down below that line. Still under trade receivables, do be careful. So we have balance brought down. 6,000. Delivery van next. $6,000. A quick way of ruling off an account is this. Let's say I'm faced with the exam. What I could do is to just freehand like that. Draw some lines. 7,000. BAL CD. BAL BD, and you're done. A little bit faster. Now, do those accounts agree? Let's try it out doing what's known as a trial balance. Before we do that, can I just give you a second to quickly go back to your journal entries. Consider those 8 entries, 16 movements. What then happens is those 16 movements, be they debits or credits, are put into these little T accounts. We've grouped these T accounts together, but whether they add up or not must be tested. And that is exactly what we're going to do next, the trial balance. So kindly open up a new page as we check to see whether things are more or less under control. So I need the best part of a page, please. So, next step. Extract, pull out, extract the trial balance, i.e., a list of closing balances from the T ledger accounts. L-E-D-G-E-R, ledger, just an old-fashioned way of saying accounts. Ledger is an accounting book. Right, let's go. Let's have a nice column or two. Our debits and our credits. DRCR, dollars. So initially it looks a little bit like a journal entry, but in fact it's much, much more serious than that, much more important, I would say. So on the debit side, we have our bank accounts. So on the far left, I'm going to say account number. The first account, the bank account, therefore, is 43,550. The second account is capital, 50,000. The third account is purchases, 12,000. The fourth account is trade payables, this is easy, 7,000. The fifth account is sales revenue, 12,000. The sixth account, rent, seventh and eighth. So, rent is the sixth. From that account you have 450 on the debit side. Trade receivables, being an asset, will be on the debit side, 6,000, and delivery van, an asset on the debit side of 7,000. Quick check, have we got 8 accounts? Have we got all those accounts represented in here? So, now we're going to try to balance the account. The ledger account, by doing this trial balance to see whether the ledger account as a unit balances all those individual accounts. So the left-hand side, I believe, is 69,000, which fortunately equals the credit side, which is 69,000. So, would you agree? It's quite possible we could have made errors and the trial balance could still agree, of course. For example, I might have put a trade payable into a sales trade payable into a sales revenue account. But because both of them are credits, even though I've made a serious accounting error, the trial balance will not reveal that error. So if I, for example, put a trade receivable, a debit, into a delivery van account by mistake, because they're both debits, one debit is smaller, the other is bigger, and they compensate each other out. So a little later on the course, I'll show you how we deal with that. with things like compensating errors and a special topic called correction of errors, as you'd imagine. Right. We can say that the journal entry has turned up in the ledger accounts balance through the trial balance. Our last task, as the question says, is to produce a statement of comprehensive income, which is an income statement, and of course the statement of financial position. Before we do that, it may be an idea just to quickly run through these various accounts and decide whether they go into the income statement or indeed the financial position statement. Now this requires a bit of common sense, maybe a bit of imagination. Bank account obviously is a statement of financial position because it's an asset. So assets and liabilities go to the statement of financial position. All other items go to the income statement. Capital, statement of financial position. Purchases, income statement. Trade payables, a liability, statement of financial position. Sales revenue, income statement. Rent, most definitely, income statement. Trade receivables, an asset, statement of financial position. Delivery van, of course, statement of financial position. So in short, if I may just summarize for you, exam point, assets and liabilities go obviously to the statement of financial position, but quite different, so I'll do a line there to separate the two concepts. Quite different, of course, is the fact that expenses and income, that kind of thing, go to the income statement. Weaker students are stuck somewhere in this area. In other words, not sure whether something goes to the statement of financial position or whether it's income statement. Clearly, you must be crystal clear about which one is which. Right. Our last task is to somehow put together statement of financial position and indeed an income statement. Don't forget there is additional information given to you in the question of the closing inventory standing at 7,000. So I better write that in. Additional information. The closing inventory is 7,000. Now the closing inventory goes to the statement of financial position as an asset, as well as is shown as a purchase, an item of purchases that isn't used this year, as a reduction from purchases in something called cost of sales in the income statement. So it's an interesting one that actually features in both. It's quite rare to get one of those. It actually features, closing inventory features in both of those final account statements, as I'll show you. So let's open up, finally, two separate pages, one for the income statement and the other for the statement of financial position. Let me start, therefore, with the income statement of George. So a new page, please, as we try out the income statement, or comprehensive income statement if you prefer. Income statement for 2 weeks ended the 14th of April 2006, or whatever it is in the question. Careful with this, because this is a fundamental skill that you carry on to the higher levels. It's extremely important to master this at this level first. Okay, sales revenue, or just revenue for speed, from the trial balance stands at 12,000. Now this is quite an easy exercise once you've practiced a couple. I'll do a couple of dollar signs, less what's known as cost of sales. If you turn back a few pages, you'll find the formats we were looking at. So can I invite you, even as we reach this point, to pause for a few seconds and go back to your income statements and financial position statements, let's say on pages 8 and 9. Right, cost of sales, let's resume. Cost of sales, the opening inventory, there is none in this question. A debit item, so I'll say nil. Brand new business, of course. Can't have any opening inventory. Add purchases, 12,000, a debit item. 12,000 running total, less closing inventory. That part of our expenses called purchases this year that hasn't been used up. So in a sense, it's an asset, which is why it's in the statement of financial position as well. That's 7,000 we were saying, which gives us, of course, 5,000, and that indeed is our cost of sales. So this cost of sales is this 5,000, which when deducted from your 12,000 gives you 7,000, and of course that is what is known as gross profit. Quite easy, really. Away from that comes our expenses. The one expense I can see is rent. We'll come across a few more later on the course. Rent is 450. And so you have what's known as the net profit, 6,550. So if you think about it, we had some journal entries. We converted them into T accounts. We checked the T accounts, the ledger accounts, to make sure they agree through a trial balance. We then made the odd adjustment to the trial balance, which at higher levels becomes a big source of marks. Here we had the single item, the closing inventory. So from the trial balance with the closing inventory, we put it into we pick them up and put them into our final accounts. There are two main final accounts, income statement and statement of financial position. We've done the first one. So let's move to the second one next. Here we are. George. Statement of financial position as at the 14th of April 2006. Always describe the statement of financial position as at as a financial photograph, whereas an income statement spans 2 weeks, 12 months, whatever it might be. But you never say income statement as at. You always say income statement for the period ended or year ended. But with a statement of financial position, you always say as at. It's like a financial photograph. Never forget that. Don't exchange those two expressions. Okay, so an income statement spans 12 months, so you never say as at. But with a financial position statement of financial position, you always say as at, you never say for the year. Watch that. Non-current assets. Let's begin operations. The non-current asset that we had was some delivery van, if you remember. Going to last for many years, so I use the expression non-current assets. A little bit to the left, I'm going to do another dollar sign, because that's where we're going to, leaving a line, we're going to bring in some current assets, things like inventory, rather a special item. Inventory is 7,000. Is that closing or opening, do you reckon? You're right, it's the closing. Last year's closing becomes this year's opening, but this year's opening is not shown in the statement of financial position, because this is a collection of assets and liabilities as at the year end. So inventory is in place. You then have your trade receivables, 6,000. You then have your bank and cash, 43,550. I'd say bank and cash. Adding that up, I find myself with 56,550. Which, when added to the 7, is 63,550. Which I suppose I could describe as total assets. It's a very simple process, stemming, of course, from those journal entries all that time ago. Right, the second half is things like capital, which happens to be 50,000. To that we'll add the profit for the year. Excuse me, in this case, the 2 weeks, 6550, giving us 56,550. And of course, you've got some current liabilities of 7,000. So let's say current liabilities. Right, the trade payables is 7,000, which when added to the 56 is 63,550. And that, of course, is sometimes referred to as total equity and liabilities. Does that balance? Of course it does. So let's do a quick recap of this section of the syllabus. Crucial was the journal entries. How to get the journal entries right? By remembering the rule: assets, expenses, and losses are debits. If they go up, you debit them. If they go down, you credit them. On the other side of the argument, of course, to match assets, expenses, and losses, we have liabilities, income, and profits. Liabilities includes things like trade payables, capital, and so on. Obviously, the liabilities, income, and profits are credits. If you want to reduce them, you debit them. If you want to increase them, you credit them. Now, once you've got your journal entries fixed up in terms of movement, you then pick up these journal entries, and as the facts unfold, you produce these little T accounts. Sometimes several journal entries will end up in the same T account, or parts of journal entries will appear in the same T account. For example, the bank account is quite populated. Once you've done your ledger accounts, you balance them off, being very careful. Bring them down below the ruling off point to see exactly whether they're debits or credits. The next stage, of course, is to test the process as best you can by doing a trial balance. If it agrees, it isn't a guarantee that everything is technically correct, just that the books balance. You then do the odd adjustment, like closing inventory. Once that's in place, you produce the final accounts. The final accounts are things like the income statement and statement of financial position. And as you can see there, the $63,550 gives us the assurance that we hope everything is in order. Now, a long time ago, I promised you, as we started this exercise, a quick look at how I got the closing inventory of 7,000. Do you remember that? So what I'd like to do, if you'll allow me 5 minutes, is just to show you how I got that closing inventory figure. So kindly turn back to the closing inventory as we attempt this little exercise. Now, looking at those journal entries, please go back to them. I'm going to offer you a proof of the closing inventory. Very much an optional proof. I only do this to deepen your understanding. Following the date sequence, if you remember, we purchased 5,000 inventory at cost. We sold half, i.e., I suppose 2,500. Therefore, we have $2,500 worth of inventory left. On the 7th of April, we sold this remaining 2,500, therefore none left, all gone. Then, on the 10th of April, he purchases 7,000 at cost. What was that closing inventory? You've got it. It was 7,000. So that brings us to the end of this little exercise. It took a bit of time, but it is the fundamental skill in this entire syllabus.